For decades, we've been told this story that the key to being a great investor is to be cold, calculating, and completely rational. But what if that's actually terrible advice? Today, we're going to tear that idea apart and explore why being reasonable isn't just easier, it's way more effective than trying to be perfectly rational. And this, right here, this is the fundamental truth that so much financial advice just completely ignores. You have hopes, you have fears, anxieties, weird quirks. You're a real person, not just a bunch of cells in an Excel file that's supposed to perfectly execute some formula. It's a fantastic question, isn't it? We get handed these mathematically perfect strategies that look amazing on paper, but they totally forget about the emotional roller coaster of actually living through market crashes and wild bubbles. So today, we're going to challenge that whole way of thinking. So let's be super clear on what we're talking about. On one side, you've got rational. That's the mathematically perfect, emotionless plan, the one that's flawless in theory. And on the other side, you've got reasonable. That's a strategy that actually accounts for human emotion, something you can stick with for the long haul, something that works in the messy, unpredictable real world. The battle between these two ideas is what we're digging into. First up, let's figure out why these supposedly perfect, rational plans just fall apart so often. And to really see this in action, we're going to step outside of finance for a minute and into the world of medicine. It sounds absolutely nuts, I know, but this was a very real question for a 19th century psychiatrist named Julius Wagner-Jauregg. He was trying to beat neurosyphilis, which was a death sentence back then. His solution? He literally infected his patients with malaria to give them a super high, long-lasting fever. Now what's fascinating is the science here. A single degree rise in your body temperature can slow down a virus's ability to replicate by 200 times. A fever is an incredibly powerful natural defense. So from a purely scientific point of view, giving someone a fever to fight an infection is a perfectly rational thing to do. And here is the absolute key. Even though we know the logic, what do we all do the second we get a fever? We grab the Tylenol to make it stop. Why? Because fevers feel awful. They hurt. And our gut human reaction is to stop the pain. Wanting a fever might be rational, but it is not reasonable. And that exact same gap, it exists in finance. Check out this study from Yale back in 2008. The math proved that a young person using 2-to-1 leverage, basically borrowing money to invest more in stocks, would end up 90% wealthier in the long run, even if they got totally wiped out along the way. On paper, it's a rational path to almost doubling your retirement. But really, just try to imagine that, watching your entire life savings just go up in smoke during a crash, and then having the stomach to just keep going with that same exact strategy. No way. It's an impossible ask. The math might be rational, but the human pain makes it completely unreasonable. It's a perfect plan that no actual person could ever stick with. Okay, so now let's see how this whole thing plays out with one of the most brilliant minds in the history of finance. This story is just a perfect illustration of that choice between rational and reasonable, even for the pros. So, meet Harry Markowitz. This guy won the Nobel Prize for his work. He is, and I mean this literally, the poster child for creating complex, mathematically driven, rational investment strategies. His huge contribution was something called modern portfolio theory. It's this super sophisticated, famously complicated mathematical system for building the quote-unquote optimal portfolio, the one that maximizes returns for a certain level of risk. It's the dictionary definition of a rational approach. So you'd think this genius would use his own complex theory for his own money, right? Well, how did he invest back in the 1950s? He didn't use his model at all. He just split his money 50-50 between stocks and bonds. That's it. Simple, balanced, and a universe away from the very theory he invented. So, why? Why did he do it? It's because he knew himself. He explained his real goal wasn't to squeeze every last penny of performance out of the market. It was to build a portfolio that would minimize his future regret, one that would let him sleep at night no matter what crazy thing the market was doing. He wasn't being rational, he was being reasonable. Alright, so if even the Nobel Prize winners are choosing reasonable over rational, what in the world does that mean for the rest of us? Well, this next part is all about how we can take our own human quirks and turn them from weaknesses into our biggest investing strengths. You know how financial gurus are always saying you have to be completely emotionless about investing? Well, that's just a mistake, Being emotionless makes it really easy to just walk away when things get scary, but having a positive emotional connection, actually loving your strategy, believing in it, that's what gives you the grit to stay in the game when times get tough. And this shows how some supposedly bad habits can actually be pretty reasonable. Take home bias, investing mostly in your own country. It's not mathematically optimal, but if that familiarity gives you the confidence to stay invested, that's reasonable. Or having a small fun portfolio where you pick a few stocks. It can scratch an itch that keeps you from messing with your important retirement funds. Even Jack Bogle, the godfather of index funds, admitted he invested in his son's active hedge fund because you know what? Sometimes life and family are just more important than being perfectly consistent. Okay, let's bring it all home. What's the bottom line here? It's all about finding what works for you, the person, not you, the spreadsheet. And there it is, the single most important idea in all of this. The best plan is not the one with the highest theoretical returns. It's the one you can actually, truly stick with through thick and thin for years and for decades. Sustainability beats perfection every single time. I want to leave you with this final thought. A leveraged retirement portfolio. Sure, it might be technically true on a spreadsheet, but in the context of a real human life, with all its fear and emotion, it's just nonsense. So ask yourself, is your financial plan built for a spreadsheet, or is it built for you?